Flat close yesterday, pretty much for the market, slightly up there, 0.09%, but it's been a negative start to the month of November. Which sectors at this point in time are receiving the lion's share of attention?
Well, I mean, as usual, Samantha, given the volumes and liquidity associated with the banking sector, we normally expect activity in that sector to dominate. You know, with consumer stocks, they're pretty rich on a relative basis, and in some of the construction names, for instance, the liquidity levels are not really such that investors can really drive their Nigerian holdings through those sectors. So typically, you know, the banks remain at the center of activity.
And banking stocks receiving some attention yesterday, specifically from institutional buyers. First Bank on the gainers list. Just looking at their latest earnings report, net earnings for the first 9 months up by some 20% year on year, slightly softer quarter on quarter. Now, analysts saying that you're clearly seeing the bank has been de-risking. ROE has fallen back slightly there. Can First Bank afford to be sweating its assets a little bit more?
Well, I think the point is not really about, you know, quarter on quarter, and, you know, clearly the bank has been in a transitional phase for some time. You know, of the sort of old big three banks, First, Union and UBA, First was always the one that kind of was striking the balance reasonably between transition and risk. You know, the thing with First Bank is that, you know, it is obviously the oldest and most established brand. It has a colossal and enviable funding platform in the market, which, you know, has seen it able to sort of sustain very cheap funding. Net interest margins remain at 8.1%, notwithstanding, you know, the trends that we're seeing. This may come off a bit towards the end of the year, but you know, they remain well placed to maintain that. The issue with First Bank was always the sort of Seawolf overhang. And we're very pleased to see that that issue has been dealt with, you know, at last. You know, much of it will be sold to AMCON, and the haircut taken is likely to be around 10%, which is kind of what we were anticipating, particularly with the guidance or the read-through from Geometrics and Diamond Bank. So now that this has taken place, and it's now going to be back within single obligor limits by the year end, I think that, you know, the First Bank story remains a very interesting one. You know,
and
the
what do you think of
valuations
their
on the
African
name,
expansion plans?
well, the African expansion plans are not the main story with First Bank. You know, it's not very aggressive. They've bought 75% of a small bank in the DRC. This is, you know, we think they paid around $200 million for it. It's a very small part of their balance sheet, and they made it very clear that their expansion on a Pan-African basis will be cautious and incremental. They look to see this DRC transaction as something that they will learn from. And they haven't historically been a sort of a major acquisitive bank, so they will take this opportunity to learn how to acquire and integrate an entity and learn how to navigate a new market. They have other markets, 6 to 8 markets that they're interested in, you know, as a whole, but the main story for them will still be Nigeria, which I think is also a good thing.
Of course, strong growth opportunities there in the retail space. Do you see them making a good strides in terms of tapping into this unbanked population? And which banks do you see as best positioned to produce those kind of innovative products which will really get that unbanked population on board?
Well, the truth is that for the larger banks that have the funding platforms, they're under less pressure to create risk assets for the retail space. First Bank has the benefit of being able to attract very cheap retail funding, which is key. And, you know, incrementally we expect them to develop risk assets, but I don't expect this to be an aggressive part of their strategy. You know, and around the sort of 20% mark for, you know, their overall loan book is where they are now, and I wouldn't expect them to go much beyond that. The truth is that for the smaller banks that are more niche players, that maybe don't have as much of a sort of sustained advantage on cheap funding, they have to drive that business in order to attract the retail depositor and also to develop the margins to be able to sort of deliver the returns. So First Bank, I think, will do more. I think it depends on the advent of mobile banking also, which is yet to materialize in any meaningful way, but yep, in theory could bring in a whole raft of you know, Nigerians that are outside of the financial system into the financial system. But even that, in the first instance, will be on a likely to be on a deposit gathering basis rather than a lending basis.
And of course, we've seen the potential of that just looking at M-Pesa in the East African region. Just quickly, UBA, that stock down some 60%, looking to come to the market to raise some funds to fund its African expansion. Do the numbers and prospects from their African expansion plans justify this capital expenditure?
Well, UBA is one of the names that, looking at our numbers and our forecasting, it was clear to us that they were going to need to raise capital, sooner rather than later. I mean, in addition, their returns have been very weak. We anticipate that with provisioning that they may well have to take, through the end of this year, their return on equity will be around 5%, which is, compares with mid-teens for,
as you say, First Bank sitting at 17%, Zenith Bank sitting at 15%. Exactly,
and GT, in the early 20s. So they're performing very weakly on a returns basis. I think that it's unfortunate that raising equity at these levels when the market is as depressed as it is. But I guess they've taken the view that they need to do something now. But of the tier one names, UBA is our least favoured name. We have it on buy on account of the very cheap valuation. But we will tell investors that if we look at the fundamentals and we look at the valuations, we would be much happier holding any of the other three tier one names than holding UBA at this time. We're not so convinced about the African expansion. We think that it has been too aggressive in the first instance, and they're now having to work hard to sort of make it work and for the cost and the income elements of it to be brought into balance. So I think that they still have their work cut out, and it may be 2013 before we start to see sustainable signs of improved performance at UBA.
Rele, which is your favorite stock then in the top tier space?
Of the banks, we like First because of the valuations. We like GT, but it's trading much more expensively. Price to book is creeping back up. It was at 2 times for quite a while before the recent sell-off, and we see it inching back, that way. But First Bank is still, around 1 times book. And considering that it's now got rid of the Seawolf overhang, the fact that it still has this tremendous potential to maintain its net interest margins at a healthy level, given its 80% cheap funding base, we continue to like the name.